Welcome to this LetterOne roundtable discussion on long-term investing in a short-term world. I'm Stephanie Flanders, head of Bloomberg Economics. We're here gathered together to talk about, as we recover from the pandemic, whether we can really make long-term investing part of this new landscape, part of building back better that we've talked about so much. We have a great panel of people to talk about that. But just before we get started, I wanted to introduce Mervyn Davies, Lord Davies of Abersoch, who's chairman of LetterOne, which is sponsoring this session. Lord Davies is a former trade and investment minister who is now chairman of LetterOne. Mervyn Davies.
Well, thank you, Stephanie. I think, one of the most interesting aspects of having worked in the private equity market, but also in the public arena, is that I think LetterOne has the luxury of being private, is able to take a very long-term, 5, 7, 10-year view of businesses. And I think one of the challenges at the moment is that institutional shareholders, the owners of publicly listed companies, don't show a lot of interest in long-term thinking. And so I think the other factor at the moment is the number of listed companies across the world is shrinking. Hedge funds own a large proportion of the listed market. So even if you're a CEO or chairman, you don't meet the hedge funds and they're only owning the shares for a few hours. So I think that the hedge fund activity, the fact that there isn't a lot of institutional interest, coupled with the fact that the private markets are growing exponentially, means there's increasing pressure on the public company arena. And I think it's going to continue to grow, particularly with ESG, which is very important that companies embrace it. But I think the bureaucracy level in a lot of listed companies is stopping entrepreneurialism, and a lot of the flight of talent and capital is going into the private arena. So from where I'm sitting as the chairman of LetterOne, we're taking a long-term view of business, and I think that is going to be critical given the pace of change with climate change, with technology, et cetera, et cetera. So a challenge for listed companies, in my view.
Well, that is, we do, and we hear that quite a lot from the private equity community, and we have members of that world represented on this panel, but also others, thinkers, and other business people. So let me quickly introduce them. Ironically, we have 6 people to talk in a very short time about the long-term investing, but I know that they're going to do a great job of it. Joana Rocha Scaff is head of European private equity at Neuberger Berman, and among other things, is on the firm's ESG advisory committee. Brian Dumaine is the founder and editor-in-chief of the media company High Water Press, and is also the author of a lot of books, and I will just name one of them, Go Long, Why Long-Term Thinking is Your Best Short-Term Strategy. Matthew Agarwala is an economist who leads the Bennett Institute for Public Policy's Wealth Economy project at the University of Cambridge, and he's also heavily involved in the new Productivity Institute. Dame Jayne-Anne Gadhia is the founder and executive chair of Snoop, and made her name before that as the CEO of Virgin Money from 2007 to 2018. And she was also, until very recently, the UK government's Women in Finance champion. Reshma Sohoni, finally, is managing partner of Seedcamp, the European seed fund that she co-founded in 2007. And interestingly, it has since done exactly what I think it was planning to do, which is to back nearly 400 European entrepreneurial companies, including the extremely successful fintech companies Wise and Revolut. So welcome to all of you. There's so many issues around here. Maybe, Reshma, maybe I'll just ask you for your sort of reaction to what Mervyn was saying, and sort of his view of, what he said seemed to me you could have said a few years ago, but yet I thought we were in this world where we were all thinking differently about investment and the future of growth.
Yeah, no, I think I'll pick up on that. I think just to say, venture capital, I mean, we literally are in the business of taking the long-term view of technology that will be fundamental to how, we want to see the world in 10, 20, 50 years. So we start off with that. And a lot of the short-term pressures work in our favor in the sense whether, such negative things like obviously the pandemic and other elements to just changes in consumer tastes and behaviors and shocks work towards, where we think particularly ESG and other kind of fundamental changes need to be. So to pick up on what Marvin said, yes, we're seeing the same thing is, with that outlook, TransferWise was started kind of 2010. We're here 11 years later, this company going public. Our companies are going public, at plus 10 billion mark. I mean, that was unheard of, but it is because they're being very thoughtful and choosy about who to take around their table, on that cap table, from that first check where we write 100K checks, 500K checks, all the way to someone putting in 100 million and a couple 100 million around. And so, it is those, and a lot of those stories are founders who are still CEOs 7 years later, 11 years later. And so, they are staying private longer. There is capital there. And I think it's a lot about, the game you're playing is if you're out here to play a 10, 20-year game, you need the right allies around that table. And that's where the incredible returns are versus, the short-term rushes of the hedge funds, right? And so yeah, absolutely, we are seeing our companies stay private longer. And I think us as that first 100K check-in, we're able to get liquidity at the timelines we need, which is more around that 7 to 10 year time frame, which I'm sure for those into day trading and short-term trading, that's kind of crazy. But that's the view we have, and so it's taking that decade for companies to get into the public markets.
And Joana Rocha Scaff, is that the world that you see, or do you see? Do you also have some of the same concerns that Lord Davies was talking about?
Absolutely share the concerns that Lord Davies was highlighting. And actually, I have the statistics for the US market. So to put it into perspective, in 2000, there were over 6,000 US listed companies. There are under 4,000 today. I'm looking at the number of private equity owned companies, and it was just somewhere around 1,500 back then. It's near 9,000 now. So exponential growth, as was mentioned in the private equity industry. Now, there's lots of criticisms on private markets. At the heart of it, and just to make sure everybody's, the audience here is fully clear, private equity is not well understood sometimes by many people outside the financial world, but at its root, it's fairly simple. Investment managers set up long-dated fund structures with somewhere between 15 to 10 years to invest in companies that are private. So they're private and stay private, or they are public and then are taken private. And there's lots of criticisms about the asset class. The most common ones are obviously fees and illiquidity, obviously. But I would say that one that it would not be fair to make is that private equity is short-term oriented, because it's not. Investments in our world, they are typically underwritten to a hold period of 4 to 7 years. That's where the mode is going to be. You may come out shorter or longer, but generally underwritten to a hold of 4 to 7 years. And in our industry, you're also seeing the advent of what I would call long-term private equity funds or core funds, and they actually have a lifespan of over 10 years. So you're underwriting investments with a 10 to 12 year hold typically. So this cannot be made and dealt with short-term pressures and goals in mind. If one doesn't make technology investments, your company's technology might become obsolete. If you don't invest in the product, if you don't invest in the brand, if you don't invest in customer service, your customers might defect, churn out, and move to the competition. You have to invest in factory, logistics, and I could keep going to deliver these things efficiently over the long term. So ultimately, again, there are many criticisms about private equity, but certainly the short-term orientation would not be the case, which is very different from the comments that were being made around the public equities market. The public equities market is very much I mean, it's very liquid, so people can trade in and out. And it has that more trading mentality where you might be looking to do short-term profits. In our world, that's not possible. Your profits are going to come and materialize, hopefully, after 5, 6, 7, or in some cases after 10 years. So if you do not build better businesses, and if you don't future-proof your businesses, by the time you're actually going to crystallize that value won't be there. That's a key point.
Just to pick up, I think it's a really interesting point there. I think public equities has become, to what you just said, a realm of the traders market, and the private markets are the investors market. And it shouldn't be, as all of us who have pension money and that goes into public equities shouldn't be the case. But that is what it appears, and it's really frustrating, disheartening.
Brian, I was going to ask you, I mean, from your perspective, and you're writing about this all the time, and you're not just writing for the benefit or thinking in terms of private markets, is it possible to be following the kind of long-termist prescription and be a public company in this day and age?
Yeah, absolutely. One of the things that's happening in the public markets is that a greater percentage of investment is coming from the big index funds. I think in the States it's 20 to 30% from the Vanguards, from the BlackRocks of the world. And by definition, they're long-term investors, right? They have to hold the stock no matter what for a long time, forever, as long as they exist. So they're long-term investors. And companies like BlackRock and Vanguard are becoming more active in the governance of these companies. They engage, I think, on average, Vanguard engages almost with 1,000 companies every year in terms of, are you on a long-term track for growth? You know, do you have the values that we're looking for in terms of sustainable growth? And it is possible as a public company to aim for long-term sustainable growth and thrive in the stock market. Of course, there's tremendous short-term pressure from the hedge funds who are not long-term investors. They're just in and out of a stock. But the companies that have tried to invest for the long term and manage for the long term, often do quite well. I mean, I wrote a book on Amazon called Bezonomics. I spent 2 years studying the company and spending time with their executives. And they're the ultimate long-term public company. And everything they do is for the long term. Jeff Bezos always said, most companies are focused on the next few quarters or at best a year or two out. He looks 5 to 7 years out when he's managing Amazon. And that keeps him a step ahead of where the competition is. And, the results are obvious. I mean, it's one of the most valuable corporations in the world. And for 10 years of Amazon's 25-year history, the company wasn't making any money. I mean, it was investing everything it made into R&D, into its customer service functions, into its technology platform. And somehow Jeff Bezos persuaded investors to be patient, right? Even though we're not making any money, he focused on cash flow. And he said, if you let me invest this cash flow in growth, I will give you the results in the long term that you're looking for. And it worked.
Jayne-Anne Gadhia.
Thank you, Stephanie. Well, that was really interesting, Brian. I mean, from my point of view, I set up Virgin Money as a private company. We listed it, sold it, and now I'm running a small company again that's private. And I was thinking as you were talking that it seems to me that the thing that is most important is growth and innovation at the moment. We seem to be so much at a tipping point around the way in which consumers want to be served and the way in which companies are going to achieve what consumers want, that I'm not so sure these days that the short-term profit cycle that I was used to in the old legacy bank world is quite so relevant. If I go out now and talk about being a disruptor in my tiny little business of Snoop, I get far more interest than I used to when I was making, tens or hundreds of millions of pounds profit in Virgin Money. I was actually talking to a banker this morning about Virgin Money, funnily enough. It's 3 years since we made that sale. And he said, you know what, that's the size of business that the banks aren't so interested in anymore. We're interested in the really big ones and how they're going to survive. And we're interested in the disruptors and the difference that they're going to make. And so, from my perspective, I do think that that investment mentality seems to me to have been shifted quite significantly. And your Jeff Bezos comment makes me think about that, looking to the long term, serving the customer, being innovative and delivering along the way. I was also talking to a different company a couple of days ago. I'm on their Remco actually, and we're having exactly this question at remuneration level. To what extent do you reward short-term performance compared to long-term performance? And concluded that actually, I can't remember the proper quote now, but every journey it has to start with the first step, doesn't it? You have to get your short-term performance right in order to achieve your long-term goals. And I'm not sure it's an either or. I don't think, Stephanie, that we should be thinking, is it short-term or long-term? Let's put together a plan that's going to be exciting and innovative for the long term with the consumer in mind, and show how what we do today is going to get us to that place tomorrow. And I think actually that's, in my experience so far, what seems to give investors confidence at the moment.
That is interesting what you say about the sort of joining up the short term to the long term. I'm sort of struck by, Mariana Mazzucato has obviously made much of this sort of mission-led approach, or the sort of moonshot approach to getting things done. And it's interesting because it is about setting a long-term goal, but it's also about being completely short-term and aggressive about the pieces that go into it and what you're going to do right now to achieve that goal. So I think you're right that the two need to go together. Matthew Agarwala, you're at the Productivity Institute, I know, is quite focused on at least a piece of what Jayne-Anne was talking about, innovation clearly, but also what these kind of models for growth could be at a firm level. So, what's your take on this?
Well, I hate to be the bearer of bad news, but I think if
economists always have to be, it's my you're always like
your
cold,
job.
You're the cold water correspondent. I'm sorry, but
so I suppose, as you say, maybe I should have picked a different field, but not just am I an economist, but I also have a lot of research on environment and climate. And so if we're thinking about the pressures that we're facing now, following the pandemic, following a really sort of long-term evaporation of productivity growth in developed economies right across the world. Since the financial crisis in the UK, it's been 0.03%. I mean, a tiny productivity growth. How do we start to invest now to get beyond this? Not only coming back from COVID, not only addressing the long-term productivity slowdown that we faced, but responding to the pressures we're going to face from climate change and further environmental degradation. And the way that we do this is going to have to take a long-term investment perspective. But it's not just long-term, it's also broad-based. So when I use the term capital as an economist, and I'm explaining economic strategies and how we might spur growth for the long term, I'm not just talking about financial markets capital. I'm talking about real, tangible, physical assets, infrastructure, plant and equipment, factories and buildings, and the capacity that all of our physical supplies have to produce and support output long into the future. But it's also natural capital, a stable climate system, healthy, clean air that we can breathe without getting sick and then having to take time off work as a result, and reducing cognitive capacity and labor productivity. It's our social capital, the amount of trust that we have in each other, in businesses, and in governments. If we cannot trust a government that's making a net zero pledge, that we're going to decarbonize, we're going to take internal combustion engines off the roads, then we can't plan to invest for the transition. So it's a broad set of capital assets that we need. It's human capital, health and skills, it's physical infrastructure, it's natural capital, and businesses have a huge role to play here. There is no path whatsoever from any climate projection that delivers net zero without mobilizing private finance. The sums of investment that are needed are far higher than the public sector can handle. So the role of the public sector isn't reduced by this fact, In fact, maybe even it's elevated. The role of the public sector is to crowd in private finance from every angle, from private equity, from publicly held companies, from long-term institutional investors, but it's to crowd in private finance in pursuit of net zero, in pursuit of the infrastructure changes, in pursuit of the changes in skills of the labor force that are going to be required. This is the only real way that we're going to be able to grow out of this pandemic whilst meeting net zero targets for the long term.
Reshma, and then I know Mervyn wants to get in as well, but Reshma.
Yeah, absolutely. And I'll say kind of again, shocks are amazing to do exactly that. I think, as you said, Matthew, consumers are ready. They're thinking generations, right? They're thinking, what am I leaving for my children and my grandchildren? And these are people in their 20s and 30s thinking about that. So, meeting that, what we saw in technology where we are investing in, we have a company called Garden that is in the space around nutrition and trying to help towards sort of hunger problems, nutrition problems globally. It was incredible to watch the pace of innovation, true technology innovation with vaccines and multiple approaches around different types of vaccines. And you can, almost have, the candy choice of what kind of vaccines you want, and the collaboration and the speed. And to what Matthew talked about is the real hard production infrastructure matching, software productivity, what computational power can do, what AI can do, what automation can do, coming together. And I see it. I see the benefits of, what happened with vaccines in the pandemic and the whole supply chain around that into then hard tech investing. And how many funds, to say, to your point of crowding in investment, how many new funds are getting overfunded around ESG and actually making those investments where we used to think, should we really be doing this? We are, in our deployment cycle, kind of 3-4 year fund. This is a potentially 5-7 year investment, even for us, just to even get to the next round. And those are happening faster. And, I credit the global kind of collaboration around vaccines. And it's been an eye opener for the tech investment industry.
Mervyn.
Yeah, I was just going to build on that, Reshma. I think the nature of a conversation that's going on, doesn't matter whether you're public or private, in the business is changing. People are going to live longer, so why would they go to university at 18? I think the whole model for workplace engagement is going to change. You've then got the pressure of climate change, which I think, Matthew is right. I think it's good. We're not going to believe what's going to happen in that arena. Plus, the war for talent and technological disruption means you've got to move much faster as a management team. And as a leader, you've got to have individuals that have the ability to move with great agility. So I think the nature of the engagement, just to take issue with what Brian said, Amazon, look, extraordinary story, but they are an exception. If you go and talk to shareholders at the moment of publicly listed, whether they be Vanguard or whoever, and say, I want to take a 10-year view of my business because of all the issues I've discussed, we've really got to, take a different tack. I think you probably would be replaced. So I think all I would say is the nature of business, it's getting faster, it's getting harder. And I think culture, values, and speed, agility, these are all the issues that the business is going to have to address. It is easier at the moment to do that in the private arena.
Joana.
I wanted to add a few points to this discussion. Obviously, we've seen a disruption caused by the pandemic, but frankly, we've seen a lot more other than the pandemic in the last 20 or so months. I mean, we've seen racial incidents and protests. We have seen extreme climate events. And I do believe that as a result of all that is going on, there's a materially enhanced focus on sustainability by society at large. This is governments, regulators, companies and frankly, consumers. So this is a mega trend, and I'd say like the good news, I guess, I'll bear the good news here, is that I think private equity is definitely coming to the rescue here. This has risen to the top of the agenda. I remember like a few years ago, going back to the US, meeting with US private equity firms and asked about their ESG integration. They would look at us and say, can you repeat that? They wouldn't even know what that meant. Europe has consistently been at the forefront of environmental, social, and governance integration in investing and continues to be, but it's actually going mainstream. And it's not just impact funds that are being raised. Most flagship funds in private markets of larger managers are truly incorporating ESG integration in the way they invest and in the way they own businesses. And more GPs, and I have statistics I can share, and we track it, as was mentioned. I'm even on the ESG advisory committee of the firm. We track it very closely. But there's a recognition now that economic and sustainability objectives are not incompatible. In fact, they are actually increasingly correlated.
Yeah.
And there are enormous amount of studies that prove this positive connection between ESG integration and financial performance. And more important, I do believe that companies that have sustainability at their heart are actually getting a valuation premium in the market these days.
But it's not always, I mean, it's interesting. I mean, Jayne-Anne, it's not about ESG anymore, is it? I mean, ESG has, and of course, we do have some major companies now that are abolishing their ESG committees because it's supposed to be everything that they do.
Everything that they do, it's sustainability at the heart of the business, at the heart of the company.
Jayne-Anne.
Thank you, Stephanie. If I may just jump in, I completely agree with you, Joanna. If I were to look back at, you mentioned the Women in Finance report, Stephanie, that I was responsible for. I mean, the driver for that report was all about productivity. How can we make sure that we extend the workforce? But of course, it needed to start somewhere, if you see what I mean. And what happened was that we set targets for individual businesses to ensure that gender equality was something that was at the forefront of their mind, and suggested that those targets, whilst they were being set within the business, were made public so that senior management were held accountable, not least by the media for this. And I think, I wouldn't say that we've changed everything hugely, but I think we've made more change than we would have done without it. And I think, these sort of targets that we're talking about now also need to be clear and transparent, and management need to be held accountable for delivering them, I think. And actually, just pondering on it, I think that does link the long term and the short term, because we can start to set those targets today and hold people for delivering, the right sort of sustainability approach today. And if we don't do it, we're certainly not going to achieve it tomorrow.
Matthew. Oh, you're on mute, Matthew.
Sorry. I just want to pick up on a couple of points that have just been made. I'm skeptical of ESG. I have optimism around certain elements of it, but the scientific underpinnings for much of the environmental side are lacking. And there's a huge amount of research to be done here still to determine whether or not these ESG metrics are actually answering any interesting questions for us. On the other hand, if businesses use this as a way to start talking about their environmental and social and governance effects at the boardroom level, then more power to it. If it's actually forcing those discussions to take place, it can only go in the right direction. One of the challenges, though, is that we don't have the scientific underpinnings in order to validate all of these metrics. And so this is one of the things that we've been doing in the Wealth Economy Project, looking not at this ESG stuff, which there's very little correlation between the different flavors of ESG. And there's over 120 different providers of ESG metrics, and it creates a lot of noise. What we've done instead in research actually supported by LetterOne is to demonstrate that core ratings products, the sovereign credit rating, actually will respond to the threats of climate change. And we can predict how these might play out into the future under different climate scenarios. To determine which countries' credit ratings are going to face a downgrade, and what is the knock-through on that to the impact, not just on the sovereign credit rating, but on the cost of public borrowing. And then the next line in the dominoes is how does the increase in the cost of public borrowing affect the cost of private borrowing? And so we can start to calculate these things. But ESG as a blanket might not be the savior everyone's hoping it to be.
No, but Matthew, sorry, it does, what it does, it gives you a framework. We're on a journey for more responsible capitalism, if you want to, for want of a better expression. So what it's doing is giving a framework for discussion at the board, even if you're private, if you're LetterOne at the board meeting last week. It gives you a framework for discussion. I do think that if you're not on the train of ESG, either the consumers won't buy your products or your staff won't stay with you as a company and you'll die. So I just think it's a great framework and we're learning as we go along. And I do think it results in a better form of capitalism.
I think the risk is obviously that when you talk about the train, I mean, you need to be on the bandwagon, but whether you're actually doing anything substantive is sometimes the question. In fact, Bloomberg Intelligence has been doing some great work just looking at the underlying holdings of a lot of ESG indices and funds, and there's some pretty eye-opening results where people are charging quite high premium for funds which actually have, if anything, less environmental value than the S&P 500. So I think at the very least you have to do that kind of due diligence.
I think one of the things that's... Oh, go ahead, Jane.
I was just going to say, the fact that Bloomberg are actually getting under the skin of that will make businesses think twice before doing it again.
I should hope so.
Which I hope.
Well, of course, our own gender diversity index does seem to be very robust, and companies that have got the diversity.
I think one of the reasons that it's so hard to execute on ESG is to Mervin's point about, CEOs still have to get short-term results because of the way our metrics are all set up. I mean, one proposal I came across, which was, no one's that I know of has done it yet, but why not make a chief executive's stock options, or the bulk of them, vest 5 years after he's left the company, right? So he's motivated to invest for the long term. He can then invest in these different ESG initiatives, or he can create the right metrics for them and not have to be under as much pressure from Wall Street. Now, that said, we've talked about you have to have both short-term and long-term. I mean, Jack Welch said, if you don't have a short-term, you don't have a long-term. But some of the best CEOs out there look at it as an S-curve, right? You have these periods of intense investment for the long term, whether it's R&D or new initiatives, and then the curve comes down and you manage somewhat for the short term. I mean, make sure that your initiatives are working, that you've got the right people on board, you've got the right capital deployed. And once that has taken hold, you go up the S-curve again, and then you do another burst of investment for the long term. And I know Nadella at Microsoft does that. Bezos certainly did it at Amazon. And some of the best leaders have figured this out. I mean, it's not all long-term or all short-term. It's an S-curve.
Matthew, I know you're dying to get back.
Yeah, there was just one last point I wanted to make on ESG. I mean, I'm professionally critical, but as Mervin pointed out, look, if it gets boardrooms actually discussing these issues for real, rather than just as some sort of CSR marketing spiel on the side, if it gets boardrooms talking about it and provides a framework for organizing their thinking and their investments for the long term, then that's close enough to job done. Don't let ESG metrics then dictate the direction of the investments. Invest for sustainability, and the ESG should come.
Can I add a point on these? You are right, Matthew. It is extremely difficult to track ESG, and honestly, what we mean about E, S, and G varies a lot depending on the underlying company or business model. I mean, if you take an industrial company, the E will be materially more significant. If you take a software business, social aspects, data security are materially more prevalent. But again, I'm not a macroeconomist. I'm an investor. I'm very much focused on the micro. And what I'm trying to tell here is that more and more private equity firms in private markets have realized that, hey, it's actually a great thing to integrate these aspects more into our model, because it's actually sensible from an economic point of view. Let me give you 2 examples. If you can improve resource efficiency of energy, water, and other resources consumption, if you can reduce waste, if you can reutilize it, it may be extremely accretive to profit margins, but it also might reduce the tail risks and the costs of regulatory compliance down the road, and also will meet what your stakeholders and your consumers more broadly expect from you. One more, conscientious and responsible employee policies, again, may lead to greater employee retention and engagement. In the long run, it actually might impact your company's brand value, its culture, and success. So my point is that there's ways to implement this integration at the micro level that produces outstanding results, both from an ESG standpoint and from an economic standpoint.
And to add, I mean, we're at that bottom level up, right? And because we start with these hundreds of Ks and companies that are 2 people, we're at a point to influence heavily. And I'll say, as fund managers, our job ultimately is, returns and IRRs, but the sort of push has come down, and we're pushing it back up into our companies to say, every board meeting kind of goes with, as you said, for 90% of our companies are software. So it's a lot more about social inclusion, diversity. Science proves that diversity is good for you as a economically as a business. Then starting off with how many women are on your team, how many other social categories of folks on the team, and these discussions were not happening, and they're uncomfortable. They're uncomfortable the first time. They're really uncomfortable the 5th time when you've done nothing about it. But what we do see is, offline on other channels, founders writing to us saying, that got me really thinking, and I'm now looking at other channels to recruit from. I'm putting in the extra energy that I just wouldn't have before. And if it starts with, companies like Hopin had 1 person in our office, it's now a few thousand. That matters when it starts at the 2 people, because Revolutes and TransferWise, these become ultimately 10,000 person companies where they start off as 2-3 people. And so it's happening, and it's great to see the push on us coming from our LPs, and and we're pulling up again into our companies. So it's all in a really good direction.
Well, on the push and pull, I mean, as an economist, I think of it also in terms of incentives, right? And so clearly there is something that's changed in the incentives where people are at least feeling that they have to focus on these things in some way or another. But Matthew, you talked about needing to kind of hold governments to account for their zero carbon promises, and what are they doing to get from here to there? How do governments kind of set the table for to incentivize businesses who maybe don't get the kind of pressure that Reshma is seeing?
Sure. Well, I mean, there are loads of policy levers that governments can pull, and some they can push to try and align the incentives. So the most successful ones that we've seen with respect to climate have been the heavy subsidies that were given to solar and wind energy generation about 15 to 20 years ago. If you were to look at an economic forecast 15 years ago, even 10 years ago, of the cost of renewable energy generation, you would never have guessed that it would have fallen by 85% over the decade, which is precisely what it has done. You would never have expected batteries storage, the cost of batteries technology, to do the same thing, but they have, and they couldn't do it alone. This isn't just a public investment campaign. It was public investment that crowded in private investment, that enabled businesses to figure out the efficiency gains from different materials, better ways of rolling out the materials, better ways of installing the generation capacity and linking it up to the existing grid. So it's a story that starts with government investment, crowding in private sector investment, learning by doing, benefiting from economies of scale, and we've seen a complete transformation so that now renewables outcompete fossil fuels in pretty much every market in the world. That's hugely important. The next challenge, though, is going to be bigger. It's going to be harder. If you think of an energy system, which starts with generation and ends with consumption, you have a real challenge. It's much easier to change something at the input side. So rather than having a coal-fired power plant, we have a wind farm, than it is to change everything that comes after that. And that's the next step, is to change the distribution network, to change the reception in homes, so that we can update the grid, so that we can electrify homes, buildings, transport. That requires changing the full energy system. It's going to require public investment to crowd in the private sector to deliver it.
Stephanie, one of the things actually we've invested in the L1 actually with Matthew, is looking at different ways of measuring economic success. GDP, you're the economists on the screen, GDP doesn't really reflect the true picture. It doesn't take account of regional geographic differences, doesn't take account of inequality, etc. So we've been funding, and it was great to see Matthew on this call, Matthew and Cambridge on this project to look at different ways of measuring economic growth and success. Because I think if we reflect on the last, decade or 2 decades, whatever, in various countries, we've left a lot of people behind, and therefore that form of capitalism won't work. So we decided to invest in this project, and it's fascinating because, governments are going to have a different scorecard for what is success, and everybody has to be on the journey of success, not just a few. So it's been fascinating working with Matthew on it.
You talk about leaving people behind. I mean, one thing that worries me, and I don't know how much you're all seeing it more at the grassroots, but we're actually, some of the changes that we're talking about, which will be talked about in fora like this as great forms of productivity growth and great innovation, that we've had faster automation, we have working from home, which is enabling much more efficient labor approach to working techniques. But actually, that has left a lot of people in city centres stuck without jobs, because you've now moved, not just in the UK, obviously, I mean, in America as well, you see it's the unemployment rates much higher still in big cities, in part because people have now gone back into the suburbs and are not coming, or they're staying and living in the suburbs and working in the suburbs and not coming into town for their sandwiches and their everything else. So I just wonder, maybe not necessarily just on that, but if we're thinking about the sort of bumpy stage of the recovery that we clearly have ahead in different countries, what do we need to look out for? What are the pitfalls of that will put us on the wrong track when we're kind of grasping around with these supply shortages, but also trying to see some of these innovations that have come faster because of the pandemic?
I would have thought that we mustn't go back onto the same track. You talk about getting onto the right track. We've learned so much, haven't we, through the pandemic? And as everyone was talking, I was thinking of my daughter who's just gone on to uni, and her friends asking me what should they do with their careers when they leave. And I realised that I'm not saying to them what I might have said 10 years ago, which is, join a big company. I'm saying, think about how you want to change things and think about setting up your own business, for example. I would never have suggested that to, the kids 10 years ago, as I say. And so I wonder whether we really do need to think even harder than we ever have about the right education for our children against a background of such a changed economic, social and corporate environment. I think the two are very discordant at the moment. And so to your question, Stephanie, around what should governments do, certainly in the UK, I feel we still have a pretty Victorian education system, and we don't want a Victorian infrastructure. So how are we going to match those two things, I think, is really critical.
I think what we're also seeing from governments around the world, or certain governments, is a realization that the wealth gap has to be approached. I mean, in China, Xi recently said that capital is no longer for owners of the capital, it's for society. And he gave a speech in a Mao jacket, which, he goes back to the teachings of Chairman Mao, who said that we're going to use capitalism as a tool to get wealthy enough to then start giving the wealth back to the people. And in the United States, we've got Biden's Build Back Better program. Started out at $6.5 trillion. It's down to $3.5 trillion. As of yesterday, it might be a mere $2 trillion. But a lot of that is taxing capital and redistributing that to the middle and lower classes in the United States. And I think that's going to have a tremendous impact on investing going forward, because the returns are not going to be as great. I mean, they just can't be if you look at by definition. So, who do you invest in that kind of environment? And are there companies that, will do better than others? And, I think basically with all this climate talk, if you've got a low carbon solution and you want to start a business, to Jayne-Anne's point, I think you can do really well, because the demand for low carbon businesses is huge right now. I came across this Canadian company called Nexi, and they're in a very unglamorous industry. They make concrete, right? These prefab slabs, so you can make buildings, walls, floors, whatever. But they can do it using 20% less carbon than traditional concrete. And they built a Starbucks in 6 days instead of 6 months. And the Starbucks building uses 40% less energy, right? So this company is 2.5 years old. It's private. The recent round of investing valued it at $1.2 billion, right? And 2.5 years. I mean, that's, I think in this world where, traditional returns are going to shrink because of government redistributing wealth, you've got to have a really innovative idea. You've got to tackle one of our big ESG issues. And if you can do that and start a business, to Jayne-Anne's point, I think our kids might have a better future.
I guess we shouldn't kid ourselves. I mean, the amount of the return on wealth just in the last year and a half has been so significant. I don't think that, I think it would be hard to completely offset that then with the changes that are currently being considered. And actually you're seeing in the UK, governments going the other way in terms of taxing wealth. But you're completely right, Brian, that's been very much part of the conversation. But it's interesting that President Biden's finding it so hard to even do that at a time when we just saw it was actually the Generation X. I saw some figures today to suggest that their net worth has gone up 50% in 1 year. It keeps going up like that until it doesn't, right?
Can I just ask Brian a question, Stephanie? Do you think the life cycle of a company is getting shorter? There's so much entrepreneurialism, so much innovation going on, and it doesn't matter where you look across the world, it's so exciting. And we were talking about it at L1 last week. But do you think, therefore, a life cycle of a company is getting shorter?
Oh, it absolutely is statistically. I mean, I think it's 25 years now for the ones that survive past the first few years. I mean, the mortality rate, obviously, for startups is very high. But Bezos talked about this, and he said most companies go out of business after 25 years. At the time, Amazon was 26, 27 years old. And he said what companies need to do is, he calls it his day one philosophy. And what he means by that is you have to run your company, whether it's big or small or new or old or whatever, as if it's the first day of a startup. In other words, you have to have that energy and that enthusiasm and that drive to keep surviving if you want a long life. And if you don't, Bezos says, it leads to decay and ultimately death. And it caused quite a ruffle, because he said Amazon was going to go out of business. But it's that kind of thinking that I think will allow Amazon to last a long time. And I think any company who takes that kind of entrepreneurial mindset and is really up to speed on all the ESG issues, I think they have a chance of lasting beyond the average time frame.
Yeah.
Do you see, just to go back a little bit to the question I had before, I mean, we're obviously facing these supply chain sort of snarl ups. We're having to focus on the fact that, focus more on supply than demand for the first time in a long time. And this is forcing businesses to make tough decisions about temporarily closing down places or hiring workers for a much higher, in an unsustainable rate. What's the best way of navigating those kind of challenges, the ones that we're going to see in the next 6 to 9 months, in a way that works also for the long term? None of you have the answer. That makes me much more worried.
Well, what I'm seeing is everyone's raising prices, right? They don't have inventory, and my local Audi dealership usually sells 400 cars a month. I was talking to the salesman there the other day, and that particular month, this summer, he had 150 cars to sell. So what do? You raise prices, all right? You're paying $2,000, $3,000, $4,000 more for the car this year than you would have a year or two ago. I think it's temporary. I think eventually the supply chains are going to right themselves. And in the meantime, I think companies are taking advantage of it, at least in the States, by raising prices quite dramatically. And that's why we have 5% inflation out there.
I mean, the other realm is automation, and one of our companies, UiPath, which is on the NYSE as Path. I mean, that's a lot of what we invested in 7 years ago. Actually, one of their biggest early markets was Japan, where they have challenges with labor and not enough of a sort of a working population, and invested so much in automation. And I think we're seeing that companies are very actively, large companies, small companies, looking very much at what can they automate. And it's interesting where, there was a lot of kind of negativity against that when there was a lot of kind of thinking around, well, are people going to be out of jobs, and what does this mean? And now it is a panacea and a solution, because we're facing such issues around productivity and labor. So again, thinking about it as a 10, 20 year, I mean, that automation will be critical. It impacts the bottom line. It allows a company to weather short-term, supply shocks like this, thinking so short-term and long-term. Again, back to the theme of our discussion here. So automation is a massive theme.
I guess, but the sheer pace of it, I know McKinsey Global Institute had an interesting study where they thought at least 5 years worth of automation has happened in the space of a couple of months in 2020. And there are transition costs to that, because we know not everyone's going to be able to go into the new jobs, even though they're there and needed. Joana, you wanted to...
I wanted to make a quick point on this issue of supply chain issues that have been truly induced by COVID. There were halts in production that were due to the fact that people were in lockdown. There were also actually self-imposed controls by companies, because they didn't really know what was going to happen during COVID. So they cut costs, they cut capacity, they delayed and postponed capital spending investments that, of course, ultimately will impact their production capacity, because they were trying to preserve cash to potentially deal with adverse changes and impact to their business. These will probably clear itself out, but of course, we're currently in the midst of what I would describe as a recalibration in that supply chain. I also would very much agree with the points that Reshma said. This has absolutely accelerated investments in automation. This has also created a trend that perhaps not as spoken about, which is reshoring. A lot of companies have realized they couldn't be dependent on that single critical nerve point in a far remote location. So we're seeing also a reconfiguration of supply chains, whereby people are trying to create redundancy in the supply chain system and absolutely reshore pieces of their supply that are crucial and critical to their operations and business.
And is that already, we're going to run out of time in a minute, but I don't know if someone wants to come in. I mean, if we are seeing that kind of reorientation of supply chains, there's a sort of nostalgic or sort of sentimental way of viewing that people would say, well, it's closer to home, therefore it's more sustainable and is going to be better for community. You know, how true is that? I mean, Matthew, you can pour cold water on that. Should we be concerned about regionalization or nationalization of supply chains?
So for certain sectors, it's absolutely necessary. If you want to have resilience in the sector, you must have local production. Agriculture, for instance. If you want a secure food supply, you have to have some local production capacity. On the other hand, trade has brought about the greatest advancements in human welfare that our species has ever seen. It has facilitated the sharing of ideas and culture and cuisine and people all across the world, and I'm all for it.
But I do think, Stephanie, there's going to have to, as we see more and more automation, as we see more and more innovation and disruption, we're going to have to, there's an element or a part of the workforce that will have to be retooled and reskilled. And that will require some state intervention, because otherwise there'll be social problems, because there'll be an element of the population that is jobless and in trouble. So I do think reskilling, retooling, whatever description you want to, it's going to be very fundamental over the next few years, because the automation is going to speed up.
And I think that it's probably a good note to end on, but it's certainly, it feels like a challenge that governments are only just sort of getting their heads around. I mean, if we look at the last 20 years, the thing that governments have generally failed to do is to bring those held back or underskilled groups along. Certainly ones who lost out in previous technological cycles and fallouts in manufacturing have not been well served by the training policies of the last few years. So I hope that we're seeing a different kind of approach, and maybe one that businesses and investors will be helping to incentivize. So we've had a great discussion. It is now over. So thank you to LetterOne and to Lord Davies for helping to make this panel happen, and to all of the speakers: Reshma Sohoni, Joana Rocha Scaff, Matthew Agarwala, Dame Jayne-Anne Gadhia, and Brian Dumaine. Thank you very much.
Thank you very much.
Thank you.
Thank you very much, all.
Thank you.
Thank you.